This week in economics on the 2nd of August 2015, Numbers Man here. This will amount to a shorter report than what we normally do. However, we'll talk about the big event of the week. The Fed put out a report, and there is some machinations going on about a jobs report next week and how it would affect the market. But first we'll move to the Fed's report and then to the speculation about the market and try to clear a few things up here. Excuse me. First, the report of the Fed, fairly short report. It's dated the 29th of July. Information received since the Fed's Open Market Committee met in June indicate that economic activity has been expanding moderately in recent months, and that's a key, moderately. Growth in the household spending has been moderate, and in the housing sector has shown additional improvement. However, business fixed investment and net export stay soft. The labor market continues to improve with solid job growth and declining unemployment. On balance, a range of labor market indicators suggest that the underutilization of labor resources has diminished since early this year. Inflation continues to run below the committee's expectation, which is 2%, long-running objective, partially reflecting early declines in energy prices and decreasing prices on non-energy imports. Market-based measurements of inflation compensation remain low. Survey-based measures of long-term inflation expectations have remained stable. Consistent with its statutory mandate, the committee seeks to foster maximum unemployment and price stability. The committee expects that, with appropriate policy accommodation, economic activity will expand at a moderate pace, with labor market indicators continuing to move towards levels the committee judged consistent with its dual mandate. And that's important to remember. The Fed does have a dual mandate, employment to maximize employment and price stability. The committee continues to see the risks to the outlook for economic activity and the labor market as near-end balanced. Inflation is anticipated to remain near its recent low level in the near term, but the committee expects inflation to rise gradually towards 2% over the medium term as the labor market improves further and the transitory effects of early declines in energy and import price dissipate. The committee continues to monitor inflation developments closely. To support continual progress towards maximum unemployment and price stability, the committee today reaffirms its view that the current 0 to a quarter point percent target range for the federal fund rate remains appropriate. In determining how long to maintain this target range, the committee will assess progress both realized and expected towards its objective of maximum unemployment and 2% inflation. This assessment will take into account a wide range of information, including measures of labor market conditions, indicators of inflation pressure and inflation expectation, readings on financial and international developments. The committee anticipates that it will be appropriate to raise a target range for the Fed's fund rate when it sees some further improvement in the labor market and is reasonably confident that inflation will move back to its 2% target objective over the medium term. The committee is maintaining its existing policy of reinvesting principal payments from its holdings of agency debt and agency mortgage-backed securities and agency mortgage-backed securities and rolling over maturing Treasury securities at auction. This policy, by keeping the committee's holdings of long-term securities at sizable levels, should help maintain accommodative financial conditions. When the committee decides to begin to remove policy accommodation, it will take a balanced approach consistent with its long-run goal of maximum employment and inflation of 2%. The committee currently anticipates that even with employment inflation at near mandate consistent levels, economic conditions may for some time warrant keeping the target fund rates below the levels the committee views as normal in the long term. Voting for the FOC monetary policy action were Dr. Yellen, the chair Dudley, Brennan, Evans, Dr. Fisher, Dr. Lockhart, Powell, Torreno, and John C. Williams. That is where the Fed stands as far as its accommodative policy. It continues. It is monitoring, and of course the dual mission of the Fed. And this is what many economic writers, pundits forget. The Fed does have a dual mandate: maximization of employment and, of course, stability. And in their stability part, the economy must remain stable. And that is a very good objective there. It is a long-term objective. And one of the objectives in an industrialized capitalist society, or modern capitalist society, is very hard to sustain. The whole idea of bubbles and recurring recessions, if you go back to 1980, you look at economic history, you'll see these recessions popping up roughly about every 24 months. Under Ronald Reagan, you had one recession, and then you had another recession there. And then, of course, the market, when it dropped 500 points. And then, of course, you had another small recession. And under the first President Bush, George H.W. Bush, there was a recession leading up to the 1992 election. And then under the Clinton administration, the economy got out of the recession, and then, of course, we had what was called the dot-com boom. An aggregation at best in the economy, something that was a very strange situation. We had a boom, created industry, jobs, etc., development. Many of the companies were in business for 1 or 2 years and were never expected to make a profit, which normally business does not do. And in 2 years, usually it's the third year. And thus then came a bubble. And that took us into the 2000s. And under the Bush administration, the bubble had burst, the dot-com bubble, that is. And then came, of course, 9/11. And there was a government stimulus in spending that they don't talk about $1 trillion. And then, of course, a war. However, the economy moved on, and then came the real estate boom in the second Bush term. And, of course, that bubble was pierced also. And down the economy went. And of course, in the final stages in the 2008 election cycle, the Depression came. And this is one of the characteristics has been of modern capitalism, and this was a worldwide depression. It was called here the Great Recession, but in the rest of the world it was the Depression. And the world economy is still lingering with the aftermath of that in terms of demand. And of course, recently the crisis in Greece, nothing new there as far as that particular crisis is concerned. But we continue to focus, at least in the U.S., this whole idea of job creation, and where the markets see job creation now is a little bit different than what we would normally expect in terms of where the expectation is that roughly 220 jobs per month is expected, and that is looked at as normal. But however, with the slack in the market out there, you need to create 320, 350 jobs to pull the slack out of the market. And that in itself is a very, very important situation. And this is one of the problems that we see and continue to see. And let me just look very quickly at some information here. And hopefully, if we are not having, no, we are not. Nonetheless, this is a gross domestic product. This is released on the 30th of July. And gross domestic product, the value of production of goods and services in the U.S. This is the advanced estimate here released. The increase in annual rate of 2.3% in the second quarter. That's Q2 of 2015. The advanced estimate released by the Bureau of Economic Analysis. In the first quarter, the GMP increased 0.6%. That was revised. The Bureau emphasizes that the second quarter's advanced estimate released today is based on source data that are incomplete and subject to further revision. The second estimate for the second quarter, based on complete data, will be released on the 27th of August. The increase in GDP in the second quarter reflects positive contributions from personal consumption, expenditures, that is PCE, exports, state, local government spending, residential fixed income, were partially offset by negative contributions from federal government spending, private inventory investment, non-residential fixed investments. Imports are subtracted in the calculation of GDP. The annual revision of national income product accounts, the estimate released today, reflects the result of the annual revision of national income and product accounts in conjunction with the advanced estimate of GDP from the second quarter of 2015. The addition to the regular revision of the estimate for the most recent 3 years and for the first quarter of 2015, some series are revised back further. And of course, as a technical note, we won't get into that one now. But the acceleration in real GMP in the second quarter reflects an upward in upturn in exports, and acceleration of PCE, a deceleration in imports, and an upturn in state and local government spending that are partially offset by a downturn in private inventory investment, in non-residential fixed investment, and federal government spending, and a deceleration in residential fixed investment. The price index for gross domestic purchases, which means prices paid by U.S. residents, increased 1.4% in Q2, in contrast to a decrease of 1.6% in Q1, excluding, of course, food and energy prices. Energy prices, incidentally, declined 20% in July. The price index for gross domestic product increased 1.1%, compared with an increase of 0.2%. Real personal income consumption expenditures increased 2.9% in Q2, compared with an increase up 2.8% in Q1. Durable goods increased 7.3% compared with an increase of 2%. That would have been in Q1.